Hello, everyone, and welcome back to the latest episode of Real Take Real Estate, where we give you the real take on today's housing market and everything real estate. I'm your host, Maddie Maloney, and I'm joined alongside my co-hosts,
Joe Sambear
and Sam Fada.
Today, we are going to be talking about home equity loans and everything that goes into a home equity loan, what it is, and some different options that you have, because oftentimes we get people that come to us that say, hey, so I know I got a decent amount of equity in my home. I want to be able to utilize this for various reasons, but people often don't know, what all that entails, what the rate looks like, what it's based off of, what payment scenarios they have, and just have a lot of questions. So it's great that people know it is available, but we're here to, go through the different options and let you know how you can use it to your benefit and really what that whole product encompasses. So Sam, I'm going to start off with you. Could you just let our viewers know what is a home equity loan and what does that entail?
Yeah, absolutely. So basically, to start, the equity in your home is simply the difference in the current value of the home minus what you currently owe on your mortgage. So if you have a $200,000 home, that's today's value on it, and you owe $150,000, you have $50,000 there in equity. So that $50,000 can be used, some of it could be used to borrow against to get you a new loan to use for, various things. It could be home improvements. It could be debt consolidation. It could be, for future investments if you were looking to purchase investment properties or anything really. It's basically a loan securitized by your home, and it's not tied into your current first mortgage. So it is a second mortgage on your home. And people typically do those versus a personal loan, going to their bank to borrow just on a signature loan because it's securitized against your home. So it's often a lower interest rate than just a personal loan.
So that was a great point right there where you said it's a second mortgage, not tied into the primary. Because I often have people come and ask, they're like, so I got a 3.25% rate on my current mortgage. I need some equity, but I don't want to do full refinance because I want to keep this rate. And oftentimes they think that, any type of new mortgage on their property or anything like that is going to change the rate on the loan. So this home equity loan is separate. It does not change any of the terms or the interest rate on your primary mortgage, which oftentimes people are very happy to hear. So definitely want to make that point clear. Okay, so a home equity loan, you kind of went over what that all entails. And one thing I want to point out that you said is it goes off of today's value. So say that you purchased the home maybe a few years ago for $175 and your current loan amount is $150. We don't have to go off of that previous purchase price or previous appraised value because home values are appreciating right now. So you're really able to tap into that. And that's, again, one of the great benefits of home ownership is that you're able to gain this equity in your home that you're then able to use in the future for home improvement, for debt consolidation, which is really just a great benefit. So those were some really great points. So Sam, do you want to go on to, the difference or what all encompasses a home equity line of credit?
Yeah, absolutely. So the home equity line of credit, there's two different options that we offer. And the first one is a home equity line of credit, which works like a credit card similarly. So really, if you are doing an equity loan or a home equity line of credit, you don't borrow it all up front. So you could do a home equity line of credit for $50,000, and at closing, you'll get a checkbook, and it won't fully fund. You won't have a payment right away. You can draw it as you need, and you can pay it back as you need, and it would be available to you to borrow against and pay off. So that's the more flexible option of the two, and then Joe, I can kick it over to you to talk about the closed-end second.
Yeah, the closed-end second, just as it's defined, closed-end, where the home equity is open-ended. The closed-end second is a fixed, non-variable interest rate product. It's like what you'd see as an installment or mortgage, an amortized loan. So it gives you more stability in knowing this is how much my payment's going to be. I'm going to be making principal and interest payments, and you receive all the proceeds all at once. So you go to the closing, when the loan funds, you receive all the proceeds and start paying interest on the whole amount. Where obviously the home equity line of credit is a line of credit available, so you're not paying interest. That's the major difference between the two. The variable interest rate on the home equity line, and maybe you can talk about the variable interest on the home equity line.
So the line of credit is tied to the federal prime rate, so it can fluctuate up and down depending on what the market's doing. So, that's definitely the more flexible of the options, but, you can pay more interest if rates go higher, but you could also save more if interest rates go lower, where that fixed rate and term, you have a set monthly payment. It's fixed for 10, 15, 20 years, whatever you choose. And you have that same monthly payment for the life of the loan. So that one is the more, if you're consolidating debt, that might make more sense to do that, because then you've got that, you're going to need all the funds right away. You have a fixed payment. You're trying to improve your cash flows, if you have too much credit card debt or something along those lines. So that might make more sense in those scenarios where the home equity line of credit can be kind of used as a safety net, to where you might do some future renovations. You might need money for later on if you have a kid getting married or something along those lines, just to use as an added safety net. The equity line of credit is good to have, but the fixed term is the, more, you'll know exactly what you're getting with that.
So for the fixed term, I feel like people typically use that when they know exactly how much funds they're going to need. Maybe they're doing home improvements and they have their bids. They know exactly how much. They really don't want to mess with the adjustable rate because they want to stay stationary. They want to have that peace of mind that their rate's not going to change. They're comfortable with the payment that we send them. And so they're good with making those principal and interest payments right away. And so one other thing with the closed-end second is that there are different loan terms for this program. Depending on what bank or what institution you're going with. In our instance, we have a 5-year, 10-year, 15-year, and 20-year. So the shorter the term, the higher your monthly payment is going to be, but most likely the lower the rate is going to be, the lower your term amount is. And then, so that's just one option with the closed end second, having that peace of mind. But then when looking at the home equity line of credit, you just have a little bit more flexibility with that. So we often see that one with, maybe debt consolidation, maybe some, they just want the emergency fund opened, and that just seems to be the best option for them there. So what it looks like when you come to us for a home equity line of credit is, maybe you've only heard of the line of credit with the adjustable rate, making interest only payments. I'm still going to present to you and offer you both scenarios, because sometimes maybe the closed-end second is more favorable or better for your situation. So we're going to look at what you currently owe on your home. We're going to look at the estimated appraised value, because at this point, when we're just doing the scenarios, we don't have that appraised value just yet. We have some automated values that we can run and some estimators to see, but we may not know the exact appraised value, so we may just be estimating at this point. If you do choose to move forward, at that point, we may be ordering a full appraisal just to see exactly how much value that we're going to be working with. But we're going to go through with you and lay out all the terms for both of the products so that you can see and really know what's going to be best in your case. So when looking at what's going to be best, we're going to look at, what is more important to you? Is it a lower payment? Is it the flexibility of, making interest-only payments, paying back whenever, paying on principal when you're able to, or, paying down the line? Or do you prioritize having that fixed rate? So we're going to see what your options are, how soon you want to pay off the loan, and that will help us guide you to what program we think is going to be better when looking at the adjustable rate versus the fixed rate product. So I just want to open it up to you guys. have you had any instances where you've really been able to help someone with a home equity loan or describe this and it just really helped them?
Yeah, Maddie, I think really understanding their, like everything else we're trying to accomplish, understanding their goals and objectives and timeframes really will dictate which path we go. You know, if you find someone that said, I might need some emergency money, well, clearly the home equity line of credit is going to be more likely the option that makes sense for them. Or I'm starting this home improvement renovation and I'm not sure we haven't got the quote back. I think I can pay cash for half of it. I might not even need to tap into this. That's a great product.
Yeah.
When I have maybe a first-time home buyer, that after a few years, they have some debt consolidation and they're budgeting and they're really focused on like bringing that debt down and really budgeting on a monthly basis, all their numbers, they're definitely going to be someone we've seen take advantage of the closed-end second mortgage. And that can be life-changing. I mean, bringing debt consolidation, knowing exactly, spreading it out over a period of time can really open up that cash flow, because a lot of this discussion is cash flow, monthly cash flow. What are we trying to do to control it and keep you in budget?
And that's the big thing too. A lot of people, you know, because for whatever reason, life happens. You know, we'd had to put this on a credit card, put that on a credit card, and before you know it, you're behind. But if you have all that equity there in your home, you can, you know, consolidate it to a closed-end second loan with a fixed monthly payment, and you're going to be paying, you know, saving potentially thousands of dollars per month compared to making all these credit card payments. So that can be life-changing for people.
Definitely. And sometimes I get people that say, you know, I really don't know if I want to take out this loan to pay off my other loans. It really doesn't make sense. But when you look at the interest rate on the credit cards that you're looking to consolidate, you know, it makes sense when those interest rates are a ton higher. Maybe right now they're 13%, ranging up to 18%, or wherever they are. When you look at the home equity line of credit, it is typically much lower than what those credit card payments are going to be. So that's where the benefit comes in, because not only is it going to be a lower interest rate, but you also have the flexibility to make those interest-only payments on the line of credit as your minimum payment. So with the line of credit, you're not going to be making the interest-only payments for the entire time. It's a line of credit that's open for the first 10 years. So during that 10 years, it's like an open credit card that you can use, make the interest-only payments on the balance that you use. So say you take out one for $100,000, but end up only using $50,000 to consolidate debt. You're only making interest-only payments on that $50,000. And then once that 10 years is up, then the line of credit closes, so you're not able to draw on it anymore. And then for the remaining 15 years of the life of the loan, you will be making principal and interest payments at that point. So that's when you pay it back. But you can definitely pay down the principal during that initial 10 years as well. So say, again, that you took out $100,000, only used $50,000, but then were able to pay back $25,000 during that time. Well, you do have that $75,000 available still throughout that 10 years when it is open. But then, go ahead, Jeff.
That's a nice point, because what I do see also, one of the benefits I wanted to interject, because what's nice about the home equity line is from the cash flow perspective, if you did use that $50,000 and you just happen to have $50,000 in all your savings accounts kind of set aside, you can be more aggressive with paying that HELOC down, knowing you can access it again. So that's another good point, is some people really like that feature of being able to like, okay, I know this is emergency. I'll pay the line of credit down to zero, and I know that tomorrow I could come back in and pull some equity out in case of emergency. So you can be much more aggressive about paying it down as well.
Definitely. And we really see this being a great option for people today, because people are getting into a little bit more of credit card debt, and it just opens up options, help you to pay it down. Also helps to improve your credit score as well. If you were maxing out some credit cards, you know, paying those off, only having one payment altogether. So it is a great option to be able to use that equity and really take advantage of your home ownership and use all of the benefits there. So Sam, I just want to go back to you. Any other last comments on the home equity line of credit versus closed-end second, or maybe some misconceptions that people have?
I think one thing I don't think we touched on was, if you value of your home is $200,000, you only owe $150,000. You can't necessarily access all $50,000. So there is a maximum amount that you can borrow against that equity. Typically, depending on lender, we can loan up to 90% of that appraised value minus what you currently owe on it. So there's still, you have to keep that 10% equity stake there, because there's too much risk for the bank to loan 100% of the value of the home. There has to be that cushion there. So that was one thing that I think, should be touched on, was that you can't just take all of the equity out in your home. There are limits depending on that appraised value.
And cost. The home equity line tends to be a little bit lower cost than a first lien full refinance. Mm-hmm. The close-end second is a little bit more expensive than the home equity line of credit typically, but again, less expensive than a first lien refinance or purchase.
And sometimes, depending on situations, depending on where the market's at, and, if you do need more of that equity in your first mortgage is small, it might make sense to combine the two and do a full cash out refinance versus an equity line. But that's, again, all your options. We'll definitely look into them and see what makes the most sense for your situation.
Definitely. So those are just some great points about how to use everything that goes along with home ownership, tapping into that equity. So we hope that helped to clear up, what is a home equity line of credit versus a closed-end second, how to tap into that equity, and what to expect during that process. So thank you everyone for tuning in today. Again, feel free to message us on social media, give us a 5-star rating, let us know how we're doing, and feel free to reach out to let us know of any topics that you would like us to touch on in the future. But that is it for right now. Thank you so much for joining us on Real Take Real Estate.